Okay, in this chapter we're going to talk a little bit about some cash management issues. So we're going to talk a little bit about savings, we're going to talk about debt planning, etc. Before we get into that, I guess the first step for us to kind of understand the impact of debt is to understand the concept of net worth, right? So net worth essentially is the equity section of a balance sheet. It's the total fair market value of all the assets that you own, less all the liabilities. So said at, I think a little bit better way might be, if you sold everything you owned and you paid off all of your debts, this is the amount you could live off for the rest of your life. So now net worth is a planning concept, because your objective is to create a situation where you have enough net worth so that you can quit work, retire if you will, and live for the rest of your life. That is the goal of net worth planning. So we have to calculate your current net worth, set some goals for increasing that over the future, and of course we obviously have to have ways of getting to that point, right? What strategies are going to be used to get to that final goal of what you want your net worth to be when you get retirement. So what are some reasons for undertaking this plan? Now, obviously we need to establish just some discipline, some financial discipline, and understanding, if you will, of what you need to do and where you're going. And I think this is really better. I don't like the word discipline. It sounds like something that you have to follow when there's some pain involved. It's really just more identifying where you need to go. Again, finding yourself a target, if you will, right? Again, of course, we want to measure. We want to have something we can measure against, so we can find out whether or not we're moving forward or not. And quite frankly, in the end, the understanding of where you are and where you need to go should allow you to feel a little bit more financially secure about yourself. So again, once we pull all of our information together, what happens if net worth is negative? Well, obviously we need to find ways to increase your equity. So we need to concentrate on reducing your debt, right? We need to get a higher investment rate of return, and possibly this may force us to revise our goal setting. If we do have positive net worth, we still aren't done with our work. We still have to check on the growth. We have to make sure that we're moving towards our targets, right? And of course, if we're off target or if our strategy isn't currently working, we're going to have to make changes in that strategy. So the first worksheet that we can use is something called personal net worth. And if you, again, go to the financial spreadsheet, you can find this listed there. But here's a place where you can identify the assets that you own, right? So we have liquid assets, we have investment assets, long-term. Those investment assets are either short-term or long-term. Obviously, we want to include our retirement income here, our retirement accounts, both individual and corporate. If you have other investments in businesses, partnerships, etc., those need to go under other investments. And then, of course, we have investments in personal assets that you want to incorporate. On the right-hand side, that's where we have to list the liabilities. What's your total consumer debt in current bills, in credit cards? What about installment loans, other debts? Again, we don't need to know exactly what these things are, but we do need to make sure we have all of them included here. And then we need something more referenced as long-term debt. Student loans, mortgages. I mean, these are things that are like really long-term things that could have a 10, 20-year lifespan. That's what we need to incorporate in this long-term debt piece. Again, when we're done here, the plug figures are net worth. So in this case, this particular couple person has $76,000 in net worth. That's 40% of their assets represent ownership. It's equity. So maybe that's a little high, maybe it's a little low. We know that they have $100,000 worth of a mortgage. So if that mortgage were to all of a sudden get paid off, I don't know how we would do that, but let's just assume that it got paid off, then the residence remains the same. That's $150,000. But now we get rid of this $100,000 liability. All of that goes to net worth. So again, we need to find ways to increase the value of assets over here, and of course decrease the cost of acquiring those assets, so that we're not borrowing, we're using cash if we possibly can do it at all. So what about cash management, right? If your total savings are falling short, then obviously we need to have some corrective actions. Well, if you're running short of cash, what are your options? I mean, you can reduce your expenses, you can increase your income, or try to do a combination of both. And quite frankly, I find most people have a lot of trouble in this area, trying to understand, well, how do I go about that? So, again, let's take our picture, let's focus down again. Cash flow management. We want to, this involves the generation of surplus funds. What can we do with surplus funds? Certainly you can conduct ongoing family operations, you can create emergency funds, you can acquire more productive assets. Obviously it prevents illiquidity, and of course maybe we could even save some money along for children's education. As a planner, we need to obviously underscore the importance of this control of cash. And I don't think, I mean, if you can put the cash management in the context of a business, it doesn't matter how much profit you have. If you don't have money in your checking account, you can't buy things, you can't do things. So we need to constantly strive to make sure that clients, make sure that we understand the importance of wise cash management tools. One of the things that can help us do this is to have a budgeting process, right? Essentially, this involves some projecting of cash flows, trying to figure out where we're actually spending our money, where those future expenses are going to come from, and quite frankly, also where's the cash going to come from. And one of the things I like to point out here is a lot of people just don't like the budgeting process. They don't like the word budget. Nobody can ever follow their budget. They're always just I just don't have the discipline to follow a budget. And quite frankly, I think at least at this point, this budget isn't as important as thinking about controlling what you do. It's really a realization. It's a realization of exactly where the cash is coming from, and at least where the cash is going today. What's happening today? Once we can see the inflow and the outflow that we've been spending over maybe the last year or last couple of months even, we can then ultimately maybe see where we could make some changes. So again, this cash flow analysis, it involves what? We need to have information about inflow and outflow. We need to develop a cash flow statement. In the end, we have to calculate the net cash flow for the individual. So again, what are those steps? Gathering data. We need to estimate possibly future income and expenses. And then, quite frankly, again, we need to construct a cash flow statement. So again, we have a worksheet that can allow us to do this, right? This worksheet, the cash management and budget, is a fairly, it has a lot of columns. This is the far left side of this worksheet, where essentially what we want to do is identify those cash inflows and cash outflows that happen every single month. Doesn't matter what happens, you have to make these payments. So they're fixed income and payments, if you will. So we need to understand, where does all the cash come from into the family? Where do the taxes go? Federal taxes, state, local, real estate. How are those taxes ultimately paid out? What are the insurance premiums that we have to make? What are the debt payments that we have to make? These are our installment kinds of payments. And quite frankly, and then we also need to identify what cash then goes towards retirement plan. Whether they be personal retirement, personal savings, emergency funds, whatever, we need to identify what those cash flows are and how they go out. In this case, we could do this for a year. You could also do it for a month, but it makes a little bit better picture to look for a year. So then we end up with those numbers transfer over here, and we'll end up with some proportions. The number that plugs out at the bottom is living expenses, right? These expenses that we've incorporated up here are all the expenses that you have to pay regardless. The living expenses incorporate a concept called discretionary income. Although some of these you have to pay, you have some control over how much is spent on each one of those things. So here, what we can do is you can put the last 3 months of your checkbook in here. So again, for housing, what are the expenses that you've paid towards your house over the last 3 months? Family, transportation as far as gas and oil, maintenance on your vehicles. What kind of giving do you have? What's your leisure picture look like, right? How much money do you spend on vacations, hobbies, entertainment? I've separated cable from entertainment here because they're really two different kinds of things, I guess. But in the end, we'll have our numbers that plug back in here. We know what's our total cash flow, total tax cash flow, what's the total insurance cash flow, total debt, total savings. Those things are transferred into this blue column from that previous column. But now we have here this living expenses that in the previous column, in this previous column is a plug figure. Now we're going to find out, well, this is exactly how much money we do spend. So it's going to plug in here this $13,000 is the sum of these things up here. So now we have what? We know the cash inflow. We know the total cash outflow. That's going to give us, in the end, what's referred to as discretionary income. So this discretionary income, for lack of a better definition, says, look, after you've paid all of your bills at the end of the year, this is how much should be left in your checking account. So in class, we'll talk about this a little bit more. But think about it. If you had money left over at the end of the year, what do you do with that money? Do you pay off bills? Do you invest it? Do you put it in an emergency fund? What happens to money that's left over at the end of the year? Sometimes a better question is, what happens if there's no money left over at the end of the year? So again, back to our planning steps. Once we understand the concept of discretionary income, obviously we want to try to increase that number. We need to minimize expenditures if possible. We need to then help to maybe think about revising some goals. If we can't reduce expenses at all, if there's nowhere to reduce expenses and we still have shortages, we have to figure out how are we going to move forward? How are we going to save some funds? A good place to kind of start thinking about this discretionary income is basically talk about goal setting, right? I mean, what is the goal that you want to have, right? What is the savings needed in order for you to achieve these different goals, right? What is your goal? I would like to be able to, I want to go on vacation next year. So I need to have $4,000 to go on vacation. I need to start saving for that. Well, we need to put that into a plan. We need to understand and get a feeling for exactly what it is that we're going to need to do that. So maybe the answer in the end is, I can't spend $4,000 on vacation. We're going to go on vacation, but maybe we'll only have $2,000, so we won't be able to go very far away. We're going to do a staycation instead of a going away vacation. So again, this systematic savings plan helps us develop these goals and to understand the process of getting from point A to point B. Your text gives us a little bit of a goal setting worksheet, right, where you can plan out how much money do you need, how much savings is going to be required, what's the return that you think you can earn, by savings, and then ultimately, what's the monthly savings needed in order to do these various tasks that we have here. So again, what's an adequate saving scenario? What should you concentrate on? Well, this process, I'm sure you've heard of this in the past, but I do want to reiterate this. You should concentrate on paying yourself first. In fact, we should treat savings like they're a fixed expense. Use this in the business context, right? I'm going to save 10% of my income every month. That might sound like a lot, but let me reword this. Let's say that I want to save 15% of my income every month. 10% of that comes from retirement. So I'm going to save 10% for retirement, but I'm going to have to put another 5% away. And every paycheck you get, the very first thing that happens is you take 5% of that and you put that into a savings thing. Ultimately, that growth into that kind of investment is going to help further your growth in net worth. Again, how do we move forward? We need to find ways to reduce expenses, reduce living expenses. Probably one of the easier things to do up front, right? We need to find ways, little parts of the money that we spend every month that we need to get better control over, right? One of the reasons why I segmented the cable thing out is to try to understand on a monthly basis what percentage of your income goes towards cable TV. And of course, cable TV, it might be the only way you can get entertainment into your house, but I guess the question is, why do you have to have premium channels? Aren't there enough channels? We have DirecTV. I think I have something like 200 channels, and not one single one of them is a premium channel. So I pay for basic cable. I have 200 channels. If you can't find something to watch in 200 channels, there's a problem. But those variable costs, again, I just went back to DirecTV, and I was getting premium channels for free. Well, it just ended. They were going to increase my bill by $40 a month. I mean, $40 a month is a huge hit into anybody's cash flow. So you may want to say, I just don't need to have the premium channels. Something a little bit tougher is to try to reduce your debt obligations. That's going to take some strategy. That's going to take some planning. Of course, another way to increase your savings is to try to figure a way to increase your income. Maybe we can get higher returns on our investments. Maybe we can find income opportunities, right? We can ask for more money from our employer. We just ask for a raise, right? Maybe we get a better paying job or just another job. Is there a way I can switch non-income producing investments into income producing investments? I have a savings plan or a savings account at a bank, or I have CDs that basically don't earn anything. Well, you don't need the money if it's in a CD. It's locked up there. Maybe we could move that into some lower risk kinds of mutual funds that have higher income producing abilities. What do most people do? Most people are not going to reduce their expenses. They can